Good day, ladies and gentlemen, and welcome to our lecture series on speculate, invest, and trade. And today we are in class number 6 of our 9-part series. Now, you'll start off learning the basics of the financial markets, and then we'll move on to learning and understanding technical and fundamental analysis and how to read charts. From there, we're going to move on to trading and making smart decisions, and each lecture will slowly prepare you to move forward. So please take these lectures in order. This is class number or lecture number 6. I would appreciate it greatly if you could subscribe to my YouTube channel or click on the bell icon down below. Nobody will bother you. You'll just get a ping when I upload a new class. So your subscriptions are very, very important to me, so I would appreciate that greatly. So let's get started learning about technical analysis. And as I've told you in the other classes, each class is moving you in a direction. We're not going to start out with advanced technical analysis and breaking down oscillators and indicators until you understand all the basis of where all of this comes from. Now, technical analysis is a trading tool used to evaluate financial markets or assets to try to forecast their future movement. This is done by analyzing statistics gathered from previous and current trading decisions, such as price. Basically, all we have to use in our analysis is the open, the high, the low, and the close in volume. Market action is studied mainly using price charts and indicators to project the direction of future price movement of an asset or a financial instrument. Technical analysis is derived from Dow Theory, and this is what most people don't know. I meet so many forex traders, CFD traders, option, and they don't even know where all of this stems from. But it was Charles Dow, and we're going to talk about Dow Theory today, who observed all this and started writing about it. And he actually didn't even put it all together, but he started writing about it in the 1900s, because up till then there was no type of analysis that you could do for a market. Now, market price action discounts every factor that influences market security, and market price movements are not purely random, but move in an identical pattern and trends that repeat over time. Now, I'm a firm believer in technical analysis. I don't usually use oscillators and indicators, but I explain the markets as being completely random. They're made up of decisions by human beings all over the globe. But there are certain times in the markets that exhibit non-random behavior, and these are known as trends, uptrends and downtrends. And when the market starts exhibiting non-random behavior, we can make calculated trading decisions. Technical analysis can be applied to virtually any tradable instrument that is subject to market forces of supply and demand. Numerous technical indicators have been developed to attempt to accurately predict future price movements. Some indicators place emphasis primarily on identifying current market trends, while others identify support and resistance areas, market cycles, strength of trend, and the probability of continuation, as well as overbought and oversold indicators. The commonly used technical indicators include trend lines, oscillators, moving averages, momentum indicators, and wave analysis, cycle analysis, and we have popular indicators like MACD, Bollinger Bands. Technical analysis can be applied to charts of various time frames. Now, I stop and throw the word technical analysis in the trash can. It sounds very complicated. I call it chart analysis. Basically, it's anything and everything we do using charts. Whether we factor in risk tolerance, trading objectives, and the amount of time that one needs to determine what time frame to do analysis on and trade on. But we scrutinize charts for the hopes of having some type of importance. Now, one of the oldest principles in technical analysis is Dow Theory, and Dow Theory guides traders to today. For almost 100 years, Dow Theory technical analysis principles fascinated traders. And the basic tenets of Dow Theory is the markets move in summation of three primary trends. The primary, the secondary, and the minor. Market trends have three phases: accumulation, participation, and distribution. All news is discounted in the stock markets and all markets. The average must confirm each other. Volume must confirm the trend, and a trend is likely to continue until definite signals of a reversal. Now, Dow broke down all of this into his price development. And this is really the basis of where we got this technical analysis. But Dow was a journalist. He wasn't a financial analyst. He wasn't a mathematician. He wasn't a statistician. He was a very intelligent man who made observations and wrote about them. Nowadays, every trader's heard of the Dow Jones Industrial Average. What many don't know that the name comes from its founder, Charles Dow. He was a brilliant thinker. Dow was fascinated with how the markets move. Relentlessly, he tried to find a logic to it. We all know that the market swings result from supply and demand imbalances. More buyers, the market rises. More sellers, the market falls. And of course, volume matters also. However, this is just a starting point. The idea is that the markets move in waves, and such imbalances create them. The Dow theory was born on this principle. Later, Elliott even developed Elliott wave cycles. Dow tried to figure out human nature's influence on market behavior. After all, a combination of swings creates a trend. What if one can put an order in the market swings? The Dow theory is not only an approach Dow had to understanding markets. He wrote many reports that served as a barometer of general business activity. But he never put his ideas together. It was someone else who had to do that. Sam Nelson, a market technician of the time, coined the phrase Dow theory. He put all of Dow's observations and papers that were all about the markets, but never into a set of principles. And he made sense of them. And this became the main pillar for technical analysis. Today, Dow theory principles shape the way traders look at trends. Moreover, Dow theory technical analyst concepts have been great forecasting power. So the following are the most important considerations. The market discounts all news, a powerful statement especially for forex traders today. Now, it doesn't mean that we discount news because it's not important. Anything and everything that's happened in the outside world, whether it's Donald Trump doing something, it's some geopolitical risk somewhere in the Middle East, it's some press release from some corporation, it's a lawsuit that happened somewhere, it's some economic, the traders have already quickly either predicted what was going to happen or traded already and changed the price. So all of that news is always within the price. And the market moves in cycles, either bullish or bearish ones. Dow identified three cycles: the main movement, the medium term, and the swing term. All of those are the original names. Time has distorted this notion somewhat, but the idea remains. We still have short-term, long-term, and intermediary term trends. To this day, the Dow theory has three market movements going on simultaneously, and volume confirms trends. Okay. Volume shows, now in the forex market this is kind of tricky, because the only volume we can see is the volume on the broker's transactions or the liquidity provider's transactions on the platform. We can't see all volume in forex, but in stock markets we can see all the stock that's been traded by volume, and in the commodities market we can see all the contracts being traded. Trends exist until they don't, and we can see them with pullbacks. Dow tried to spot true reversals from fake ones. Dow theory considers the market makes three price movements. The primary movement, or the primary trend. This is where the Dow theory forex traders focus. It can last from several months to several years. Now, a smart trader Whether you're trading CFDs, whether you're trading gold or oil, whether you're trading Bitcoin, you want to look at an environmental, and I call this primary movement the environmental movement. Okay, this is, you want to know that Bitcoin has been on a steady movement up so that the pressure is pushing it up, even though we might have a short term or secondary downtrend at the moment. If you know that the traders are overall pushing it up, that means it's got some momentum, and you need to understand that. The secondary movement, this is a discretionary one. It moves against the main trend or primary one, and it goes for a few weeks or a few months. And then the daily fluctuation, they can go with or with against the main trend and can take hours or a few days. Now, this is how Dow explained in 1900. We didn't have online trading. We didn't have computers. We didn't have all this data being fed. So this still moves to long-term, short-term, intermediary term trends. Then Dow Theory considers the market makes three price moves: primary, secondary, daily. In today's forex trading, there's a trading style for each movement. Traders involved in the biggest cycle, the primary movement, are long-term traders. The next cycle belongs to swing traders. And finally, intraday traders deal with the day-to-day movement and or the daily fluctuations. You probably noticed that Dow Theory addresses the market cycles, but in today's technical analysis, the three movements represent a bullish and a bearish trend, or a series of higher highs and higher lows in a bullish trend, or on the other hand, a bearish trend, a series of lower lows and lower highs. Now, charts are key to technical analysis. This is because the most important measure of a market's past and current performance is price itself. This is the starting point for delving into analyzing potentials of a trade. Price action can be represented on a chart as the clearest indication of what price is doing. And as I already mentioned, I don't use the word technical analysis. I use chart analysis. Everything and anything we do on a chart is part of technical analysis. And charts are just graphical depictions of price, because you couldn't keep in mind how, and you couldn't even, your mind couldn't even imagine if I said to you an asset was trading at 140, 142, 140, 147, 140, 140, 140, 152, 140, 147, 140, 138, 140, 134, 130, 142. Could you repeat that to me? Could you make any sense out of it? Now, what I actually gave you was a market moving, an asset falling, but you couldn't see it. But this is one of the places where a picture is worth 1,000 words. Charts assist in determining the overall trend, whether it's an upward trend or a downtrend, either over the long or the short period. The most common types of technical analysis charts are line charts, bar charts, and candlestick charts. But today, candlesticks are outshining all the other types of charts. When using a bar or candlestick chart, each period will give you the technical information on the price from where it opened, the high, the low for that period, as well as where it closed. Candlestick analysis is especially useful as the patterns and relationships within them can assist in making forecasts about future direction of price. So candlesticks, like I said, are by far the most popular candles. We have bearish candles and bullish candles. The colors are irrelevant. You can have a green and a chartreuse. You can have a purple and a red, as long as you know which color you're using for bullish and which color you're using for bearish. What is important is the size and shape of the body of the candle and then the wicks. This tells us a whole entire story about the markets in an easy to see visual formation. And then the patterns that these candles make next to each other or independently can tell us something about the market movement. A candlestick chart displays the high, the low, the open, and the close price for each period. The body of each candlestick represents the open and closing price, while the wicks display the high and the low for each period. The color of each candle depends on the applied settings, but most charting packages use red and green today. The candlestick chart is by far the most popular type of chart used in forex technical analysis, as it provides the trader with more information while remaining easy to view, an easy to view format. There are various ways to use and read candlestick charts. Candlestick chart analysis depends on your preferred trading strategy and time frame. Some strategies attempt to take advantage of candlestick formation, while others attempt to recognize price patterns. Okay. Candlestick pattern recognition is really contrary to successful trading in the forex market, CFD market, because all of these patterns tell you what you should be doing. When this happens, do this. And it can be wrong. Now, using candlesticks is part of your strategy, and in interpreting for what price is doing as chart analysis is a great way to trade. Now, we have single candlesticks formations that tell us something about that particular time frame. We have candlesticks like hammers, shooting stars, hanging men that offer clues as to changing momentum and the potential change in the market price. And then we have multiple candlestick patterns. The main one that everybody talks about is the engulfing candle. The engulfing candle is when the current candle is the opposite color of the previous candle and fully engulfs that current candle. It tells us a shift in the market is placed. Candlestick charts help traders recognize price patterns that occur in the charts. By recognizing these patterns like bullish engulfing patterns or triangle patterns, one can take advantage of them by using them as entry points into the markets. Then, once you've got your chart set up, remember the old adage that trend is your friend. Trend lines can be used to identify and confirm trends. A trend line connects at least two price points on a chart and is usually extended forward to identify slope areas of support and resistance. So we have long-term trends, short-term trends, intermediate-term trends. Then the trends are not trend lines. Trend lines are drawn with a set of rules. And those set of rules start to make some sense of the market. And remember when I told you, when you have a trend, you have non-random movement. When you have non-random movement, you can make decisions. And so an uptrend is a series of higher highs and higher lows. A downtrend is a series of lower lows and lower highs. And there's only three types of trends: uptrends, downtrends, and sideways. The markets spend most of the time in sideways trends or ranging markets. And then you have to be able to spot retracements and reversals. A retracement is a healthy move within a trend. A trend should be a push and ease, a push and an ease, a push and an ease. Okay. We can learn to calculate using the trend line, because the ease should never break below the trend line, that it is a retracement, not a reversal. When it breaks the trend line or it makes a new lower low in an uptrend or a lower high in a downtrend, we're then looking at a potential reversal, telling us that we're getting a shift in the markets. So a retracement is defined as a temporary price movement against the established trend. Another way to look at it is an area of price movement that moves against the trend but returns to continue the trend. Reversals are defined as a change in the overall price trend. When an uptrend switches to a downtrend, a reversal comes, or when a downtrend switches to an uptrend, a reversal occurs. Determine the trends and follow them. Next, once we have our trends on our charts, we want to look at a very important concept known as support and resistance. Support and resistance is one of the most used techniques in technical analysis based on a concept that's easy to understand but difficult to master. Now, I do not ever trade without support and resistance. Like I said, I don't use technical indicators and oscillators. I use trend lines, support and resistance, and chart patterns. There are many ways to identify these levels and to apply them in trading. Support and resistance levels can be identified as turning points or areas of congestion or psychological levels. The higher the time frame, the more relevant the levels. Finding the most important ones may take many hours of practice. They exist due to an influx of buyers and sellers at key junctures. The fact that these levels slip roles between support and resistance can be used to determine the range of market trade reversals, bounces, and breakouts. The best place to buy A market is near a support level, and the support level is usually the previous reaction low. The best place to sell a market is near the resistance level. Resistance is usually a previous peak. Now, we obtain these support and resistance levels using historic prices, looking back and when the price traded in this price range in the past, what prices were significant, where did rallies stop, where did uptrends end, where did downtrends end, where were swing highs and swing lows. Now, I explain support and resistance like the floor and the ceiling on an elevator. You get in an elevator, the floor is supporting you. The ceiling is your resistance. You have to break through that ceiling to get to the next level. When you break through that ceiling and it becomes the next level, what happens? That ceiling now becomes your floor holding you up, and you have to go up through the next level. But when that elevator is coming down, the reverse occurs. So the floor is what you have to break through, and it becomes the ceiling over your head. Now, if you observe the elevator movements and say we're looking at price between the euro's now, say at hypothetically 122, so we're looking at historically how the euro reacted over 120 to 125 range. Okay, we don't care what it did at 142 or 151 or what it did when it was 106. We only care at this range. So if we observe how the elevator moves between levels 3, 4, 5, 6, 7, and 8, and we make some studies about maybe floor 3, 4, and 5 are big corporate office. Level 6 is a storage room, and level 7 is the lunch room and the conference rooms. Okay, by looking at time of day, by looking at history, by going back and looking at chart, we can see how often that elevator, when it stops at 3, does it stop 4, 5, and 6, or does it go 3 right to 8, or maybe just in the evening it jumps from 3 to 6 to where the lunchrooms are, or maybe at 12 to 1, and in the evenings it takes more trips that way without stopping at trips in between. When it's coming down and it stops at 6 where the lunchrooms are, there's a good chance it's going to go down to 3 where the offices are. And we've then determined by observation and historically looking at how it's worked in the past what levels are important based on our previous historic moves around where the elevator is now. So if the elevator is at 6 and it's 1:30 in the afternoon, I'm saying that that's the lunchroom on 6. So it's 1:30, most people are finishing lunch, and where are they going? They're going back to the entrance to their office on 3, 4, and 5. So I'm pretty sure it's going to miss 5 and 4 and go to 3 or 2. Okay, and then you can make smart decisions. Then we have moving averages, which is another basic technical analysis tool, but one that you should always trade with. We have simple moving averages, exponential moving averages, we have smooth moving average, weighted moving averages. We even have displaced moving averages, a new way of using moving averages that I've added onto my charts. Moving averages provide objective buy and sell signals. They tell us if the existing trend is still in motion, and they help confirm moving trend moves. By combining moving averages, we can see moving average crossovers, or we can see whether we're in uptrend. When the short-term moving average is moving higher than the longer-term moving average, we know that we have momentum upward. And just in the reverse, moving average are price-based indicators that display the average price of a security over a set period of time. But moving averages also take the noise out of markets. Remember, we said markets move in push and ease, troughs and valleys. There's lots of noise in the market. A moving average will help remove that noise. And then it's also the basis for many, many important indicators. MACD and Bollinger Bands both use moving averages as their center or their primary start of doing their derivative action, or their statistical and mathematical formulas, starting out with moving averages. And there's different types of moving averages. Most notably are simple moving averages, exponential moving averages, weighted moving averages, and even whole moving averages. Signals are given when shorter average lines cross longer ones. So we have moving average crossovers, which work as a good indicator for buy or sell. Then we go on to our technical indicators. Indicators are mathematical formulas that are applied to open, high, low, and close in volume that can give you some indication or interpretation of the market. We have trend following indicators, we have oscillators, we have volatility and support and resistance indicators, we have momentum indicators. So one of the most popular is trend indicators. Trend following indicators were created to help buyers trade currency pairs that are trending up or down. We have heard all called the trend is your friend. These indicators can help point out the direction of the trend and can tell us if a trend actually exists. Volatility measures large upswing and downswings of a pair or an asset. When a currency pair or an asset fluctuates wildly up and down, it's said to be highly volatile. And then we have oscillators to help identify overbought and oversold regions. While moving averages often offer confirmation to market trend changes, oscillators often help us tell us in advance that a market has rallied too high or fallen too low. Some of the most popular oscillators are RSI, Relative Strength Index, and stochastics. So each of the technical indicators can advance your technical analysis and better understand price action, but it's important to remember not to get bogged down and to choose only indicators that work for you. Don't make a whole bunch of indicators and make a mess of yourselves getting the same information. Overly complicating your approach with too many indicators can force traders to process too much information, resulting in paralysis by analysis. And then we go to my favorite place, and chart patterns. I'm a triangle trader. Patterns are the distinct formation created by the movement of securities on a chart and are the foundation of technical analysis. A pattern is identified by a line that connects common price points, such as closing points or highs and lows during specific periods. Technical analysts and chartists seek to identify patterns as a way to anticipate the future direction of price. These patterns can be as simple as trend lines or as complex as a double head and shoulders formation. A price pattern that denotes a temporary interruption of an existing trend is known as a continuation pattern. As such, careful attention must be placed on trend lines used to draw the price pattern and whether price breaks above or below the continuation zone. We have things like pennants, flags, and wedges. And then we have reversal patterns. A price pattern that signals a change in the prevailing trend is known as a reversal pattern. These are things like head and shoulders, double tops, double bottoms. And then triangles are among the most popular chart patterns used in technical analysis since they occur frequently compared to other patterns. The three most common types of triangles are symmetrical triangles, ascending triangles, and descending triangles. These chart patterns last anywhere from a couple hours, a couple weeks, a couple months, depending on the chart you're looking at. Now, I include in triangles, wedges, anything that looks like a triangle. We have all kinds of classifications for them, but I say triangles, asymmetrical, symmetrical, ascending, descending, ascending wedges, descending wedges, because they're all based on angular degree forcing price into an apex. So in any case, what happens is we have two angular lines or trend lines or support and resistance lines drawn under the price and over price. And when they're converging together, they push price into an apex. Price at some point needs to break out. Now, the biggest difference between an ascending triangle and a descending triangle, both have horizontal lines. A symmetrical triangle has both the support and resistance lines moving in almost the same degree. But they all make the same final interpretation because you can't do anything until price breaks out. So that's all for today, folks. And now we're going to go into lecture number 6, where we're going to really start breaking down all of these indicators and oscillators and start building a trading plan so that we can make intelligent decisions. And we're going to be talking a great deal about risk. So thank you very much for joining us, and see you in class number 7. Bye now.